Welcome to this introduction to the TMAM Global Monopoly Equity Fund. My name is Gerald Stack and I'm the head of the infrastructure investment team here at Magellan, the manager of the fund. My experience accounts for more than 15 years here at Magellan and over 30 years of total investment experience. Magellan is a Sydney-based asset manager and manages two major strategies, global equities and global listed infrastructure. At the end of December 2021, Magellan had assets under management of more than $70 billion US, and more than $15 billion of that was in global listed infrastructure. Today you're going to hear from three of my fellow co-PMs, Offa Karliner, Ben McVicker and David Costello. They're going to take you through the key characteristics of the investment universe, our investment philosophy and the key characteristics of the fund itself. I hope you find this informative. Thanks for watching us.
I'm Offa Karliner. I'm a portfolio manager at Magellan. The fund is designed to provide diversified exposure to high-quality infrastructure assets with monopoly characteristics, which should lead to inflation-protected, defensive cash flows and ultimately low correlation to other asset classes. The objective of the fund is to achieve 5% above inflation through the investment cycle. This is not get rich quick, it's about growing wealth with a high degree of certainty over the medium to long term. By design, the largest position size in the fund is 3% at purchase, but some of the bigger holdings include Transurban, a toll road company which has 21 concessions in urban centres and tolls on most of their roads that escalate with inflation or greater, and Cellnex, which owns telecommunication towers in Europe, and again, most of their contracts have CPI linkages in there. We also own investments in US utilities, including US integrated power companies, which stand to be amongst the biggest beneficiaries of the transition to a zero carbon economy. They're replacing regulated generation from coal and gas with renewables, and they also have to build out the transmission infrastructure to take the power to where it's needed. This will underwrite their cash flow growth for decades to come as we move to a zero carbon world.
I'm Ben McVicker, Portfolio Manager. When we invest in infrastructure, we like to find investments that can deliver very reliable and dependable outcomes. Really important for this is finding investments that can deliver reliable cash flows, because ultimately what we believe is where cash flows go, investment returns will follow over time. How we put this into practice is by applying a two-part test, what we call our definition of infrastructure. This two-part test, the first part of that is that we want to find assets that are essential services. Essential services are really important. They have reliable demand no matter what's happening in the broader economic cycle. And so really simple examples to put that in context, think about running water, electricity. These are going to be needed no matter what's happening out there. The second part of our test, and this is a little bit harder and where a lot more companies will fail, is looking for companies that have firstly the reliable demand, but also the reliable cash flow that we need. And so this really means we're trying to find investments that don't face a number of significant risks. So, key examples here, too much commodity price risk, too much sovereign risk, or too much competition in the business. And so we ultimately believe if you follow this approach, that's going to deliver the types of outcomes you expect from infrastructure.
I'm David Costello, Portfolio Manager at Magellan. The investments in the strategy fall into three categories: regulated utilities, transportation infrastructure, and social infrastructure. Our regulated utility investments provide the most fundamental of essential services: the electricity that lights our homes, the water that we drink and bathe in, and the gas that heats our homes in winter. Because these services are so foundational to our existence, demand is incredibly predictable. And because the assets that deliver these services are natural monopolies, they're subject to economic regulation. This regulation prescribes exactly what these businesses are entitled to earn, typically for a multi-year period. The combination of predictable underlying demand and economic regulation confers our regulated utilities a relatively benign risk profile and cash flows that we can forecast with a high degree of accuracy. In an often turbulent world, our regulated utility investments anchor our portfolio. These businesses should deliver reliable results year in, year out without exception. The transportation infrastructure names in the portfolio facilitate the movement of people, goods, and data. these businesses exhibit profound advantages with strong returns on capital underpinned by natural monopoly characteristics and stable, predictable cash flows underpinned by long-term contracts with creditworthy counterparties and by economic regulation. The revenues of these businesses are typically tethered to growth in consumer prices, providing strong protection against inflation. And these businesses commonly exhibit strong operating leverage and modest incremental capital requirements, giving rise to highly attractive incremental returns on capital when they experience growth. The final category of investment in the portfolio are social infrastructure assets. These assets are engaged in the design, operation, and maintenance of public facilities, things like schools and hospitals, in partnership with governments. These businesses generate stable, annuity-like cash flows backed by the full faith and credit of a sovereign counterparty. The portfolio construction of the strategy then follows a systematic approach, with position sizes determined by reference to a series of rules. Now let's be clear. When we refer to systematic portfolio construction, we're not outsourcing portfolio management to some indecipherable algorithm. These are simply prudent portfolio rules and risk controls to deliver liquidity and targeted diversification. In summary then, the strategy provides investors with efficient access to a highly defensive, inflation-linked investment exposure that exhibits low correlation with other asset classes, warranting a place in any well-diversified portfolio.
Thanks for watching. We hope you found that informative. And if you have any questions, please get in touch with a member of our team.
投資信託なら東京海上アセットマネジメント。